Hello there. So unless you've been living under a rock recently, you will have noticed we are in the midst of a long bear market and a stock market crash. That means there are many bargains to be had out there in the stock market. And in today's video, I'm going to go through what high yield dividend stocks I have been buying this past week. And best of all, they're all below book value. If you're new to this channel, welcome. My name's Andy, and on this channel, I like to talk about money and success. If you're interested in making, saving, or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you enjoy this content and find it useful, please do remember to give it a thumbs up, because that helps the YouTube algorithm, which in turn helps me. And of course, I do appreciate it. So, what stocks am I going to talk about? Well, I will put the links in the description down below so you can see what they all are. I'm going to go through them one at a time. I'm not going to take too long on this video. I'm just going to give you a very brief overview of each of the stocks. So we're not doing an in-depth analysis like I do in a lot of my videos. This is going to be much more superficial level. But the key points are they're high yield dividend stocks. So they're going to give a good ongoing and I believe growing income in many cases. They're also all below book value. So that's the first thing I want to start with. I want to explain what is book value. Please don't skip this part. It is important. I will probably make a more detailed video explaining book value. I'm only going to go through it quickly for you in this one now. So high yield dividend stocks currently below book value. But what is book value? Book value equals assets minus liabilities. Book value per share equals book value divided by the total number of outstanding shares. So buying any stock below book value is a discount for the investor, because you are essentially buying the company for less than it would be worth if all of its assets were sold off, all of its liabilities were paid off. The equity that is left, the shareholder equity, then divided by the shareholders, is now actually worth more than the share price of the shares. So you're essentially getting it at a discount. Good old Benjamin Graham would agree, as does Warren Buffett. So this is a good time to be buying stocks and shares, and this is one of the metrics you should consider when looking at buying stocks and shares. You shouldn't just look at, has the stock price gone up, has the stock price gone down? That doesn't tell you the value at all. Book value gives you a measure of the value of the company. It's not the only way to measure a company, and you should of course look at other metrics, but it is one. I will at some point make a video explaining how to work out book value. And if I do that, I will put a link to that here in this video. I'll come back to this in the future and add that in. So before I jump in and start telling you what stocks and shares I've been buying, I do need to just let you know I'm not a financial advisor. So this is not financial advice. This is just my opinions and my own research. You need to do your own due diligence before buying or investing in any stocks or shares. All that said, let's dive in. So the first stock is Medical Properties Trust. MPW. Now this is a REIT. If you don't know what a REIT is, I've made a video explaining what is a REIT. I'll put a link up there now for that so you can find out more about what a REIT is if you don't understand that. Most people who watch my channel regularly, so if you're a subscriber already, you will definitely know what a REIT is already, because you will see my most recent video, which is about EPR Properties, which is another high yield dividend stock that I have been buying recently. I've made many videos about that. I'll put a link to a playlist all about EPR Properties up there for you now as well. But let's look at this one. So Medical Properties Trust. So it had a 52-week high of $24.13. It had a 52-week low of $11.35. Its book value, hopefully you remember what book value is now, is $14.80. And yet the current price is $11.86. That means you're getting a 20% discount from the book value. So if it returns to its book value, you have instantly made 20% on your capital. But wait, there's more. Annual dividends are $1.16. These are paid quarterly, which makes a dividend yield of 9.78%. So you've got a lovely high dividend yield, and you've also got a discount on the asset, the share price itself. So let's have a look at what the analysts think. So here's the analysts' ratings and forecasts. So they have it as a buy, and you can see the 12-month forecast. The low is $15 per share. The high is the high is $23 per share, and the average is $18.14 per share. So any one of those three forecasts takes it back to above its book value. Remember, its book value was $14.80 per share, and its current price is $11.86 per share. So whichever way you slice it, there's profit to be made there. Hence why that's one of the stocks I bought this week. So let's move on to the next stock. Stock number 2, Ares Capital Corporation, ticker symbol ARCC. ARCC. Ares Capital Corporation is a BDC, or business development company. If you do not know what a business development company is, I have made videos about many business development companies. One of my favorites is the one where I compared what is the best business development company. I'll put a link up there to that one now. If you want to watch that, in there I do explain in great detail what a business development company is. But for now, I'm not going to go into that. We're just going to go through the slide. So 52-week high was $22.89. The 52-week low was $16.72. The book value is $18.82. The current price at the time of making this video is $16.88, which gives a discount from the book value of 10%. The annual dividends are $1.72. That's per year, which is paid quarterly, giving a whopping 10.19% dividend yield, which I think you'll agree is a stonkingly high dividend yield. Now, many people would panic at this point. The dividend yield so high, it must be a value trap. No, the stock market has collapsed. That is why you've seen dividend yields increase so much. Lots of stock prices have been dragged down, regardless of whether the actual company is performing well or not. Now, that's not to say that these dividends are guaranteed. I can't guarantee anything. Nothing is guaranteed in life, I'm afraid. But my research suggests these are fairly safe. Obviously, you need to do your own research to see, but if you look at the history of a company like this, you'll see the dividends have been growing over time, and therefore are likely to in the future. And actually, the way that its business is set up, it should actually benefit from the rising interest rates and make even more profit, and as a result of that, be able to share more of that profit either in dividends or buybacks, resulting in an increased share price. So either way, you should win. The only time you would fail, I suppose, or lose out would be if the companies that Ares has invested in and lent money to go out of business. Then obviously there is a potential problem there. But that's something you need to do more research in. Like I say, I've satisfied myself. It's on you to satisfy you. Let's look at what the analysts have to say about Ares Capital. Ares Capital. So the Wall Street analysts have this as a strong buy. And you can see the target price is $20 per share. The average is $21.54 per share. And the high is $24 per share. Bear in mind, this is a 12-month forecast. And if we go back to what you can currently buy it for, $16.88 per share. So again, whichever way you slice it, there's profit to be had there. And that's just on the share price, forgetting all about the 10% plus dividend that you will also receive as well. And as someone who's interested in growing my income via dividends, I'm obviously particularly interested in the dividend income, because the passive income, frankly, is what I'm all about at the moment. Let's move on to stock number 3. So stock number 3, Owl Rock Capital Corporation, ticker symbol ORCC. If you've followed my channel in the past, you'll see I have reviewed this stock in the past more than once. I'll put a link up to the most recent stock review of Owl Rock Capital up there now for you, so you can take a look at that if you want to learn more about this company and learn more about in depth what it does. But for now, let's just go through the high level numbers. So 52-week high, $15.33. 52-week low, $10.29. I should just say the 52-week high, 52-week low, they are probably the least most important metrics on this sheet that I'm showing you now. The only reason I show you it is so you can see where it currently sits in that range, because it can be useful as an indicator of where you want to buy it. Obviously, if something's near its 52-week low, that's usually a better time to buy than if it's near its 52-week high, providing, of course, the underlying company is still operating as it should be and is increasing and growing its revenues. Obviously, if the company is in terminal decline, its income is going down, its profit is going down, then obviously its share price would also go down, and then buying at the 52-week low wouldn't necessarily make any sense. But with all that said, that's not the case for this one. It has grown revenues, but you can check that yourself. That's not what this video is. Like I said, I'm fast, high level. So current share price is $10.36 against a book value of $14.48, which gives you a discount from the book value of 29%. Its annual dividends are $1.24, which again are paid quarterly, giving almost a 12% dividend yield, 11.96% dividend yield, which is frankly awesome, especially given the value discount on the actual stock itself. So you've got a potential to make almost 30% in capital gain, plus nearly 12% per year in income if it returns to its book value or above, and if it continues paying those dividends, of course, which there's no reason for me to believe it wouldn't, unless, of course, now there are things in the world, I will just interject here, there are things in the world that could go wrong. So part of the reason the stock market is as low as it is there are people that think we're possibly on the verge of World War III. We've got Putin threatening to fire nukes. Obviously, if there was a nuclear war, you can expect the entire stock market to collapse. But quite frankly, YouTube would be gone, your internet would be gone, your electric provider would be gone. Losing some money in stocks and shares, it would be the least of your worries. And mine, for that matter. We also have the small matter of rising interest rates. And if you've ever done any research into the history of stocks and history of interest rates, you will see there is a direct correlation. When interest rates go up, share prices tend to come down, and vice versa. So of course, as interest rates are increasing, the stock market has been declining. Now, one thing I will say is the stock market tends to predict ahead. So it's already factoring in where they think the interest rates are going to go. So it's when something unexpected happens, i.e. the interest rates now go higher than expected, that's when you would expect a dip. If interest rates stop being increased or start being decreased, you can expect the stock market to start to increase again. Okay, that's enough about that. Let's carry on with the topic at hand. Sorry for my divergence there. So the analysts' forecast on Owl Rock Capital, as you can see, they've got this as a buy. We've got an average of 4.64 and a low of 12, and I've managed to hide the high. I presume it's around the $16 mark looking at that. Either way, it's higher than the current price. Okay, so the next stock that I've been purchasing recently is Arbor Realty Trust. This is a mortgage REIT. I have made a video comparing this to IVR in the past. If you want to watch that, I'll put the link up there now. It will also be in the description down below, and I would recommend you do if you're considering investing in this particular stock. It is an MREIT. MREITs can be volatile at the best of times. They can also give you very, very high dividend yields, which is obviously one of the reasons I'm interested in this particular stock, but there is a risk associated with that. So if you are considering investing in this one, I would recommend you watch that previous video and do your own research first. So with that said, let's look at the key metrics. So its 52-week high is $20.74. Its 52-week low is $11.45. Its book value is $12.74. The current price at the time of making this video is $11.50, so not much above its 52-week low. And its discount from book value is 10%. The annual dividends are $1.56, which again are paid quarterly, making a dividend yield of almost 14%. 13.57% dividend yield, which is absolutely crazy, and it has been raising its dividends as well. So let's look what the analysts have to say about it. So the analysts also have this rated as a buy. Their 12-month forecast, as you can see, low is $16, average $18.60, high is $21. Imagine if you buy it for $11, whatever it was, what was it? If you buy it for $11.50 and it goes back up to $21 in a year's time, you've almost doubled your money. In fact, including the dividends, you have doubled your money. Not bad indeed. So if that pans out, wonderful stuff. Anyway, I hope you enjoyed this video. Thank you so much for watching and have yourself a nice day. Bye bye.